first webinar of the year, and thanks for taking time out of your busy or relaxing Super Bowl Sunday to join me today. I'll make this short and sweet. And I'll open it up for questions at the end so we could, have time to relax and get ready for the weekend or join our Super Bowl party. So if you have any question, please write it down and let's talk about it at the end. So that people that need to go somewhere or do something else can jump out and we can wrap this up by 4:45, 5 o'clock, the latest. I plan organizing more informative sessions like this at least once a quarter. It might be twice or three times a quarter, just depending on popular topics out there on the news and what's going on with real estate. So please stay tuned for future presentations. A little bit about me here. Many of you guys already know me. For those that don't know me, I'm a realtor based in Texas, and I have my license in Texas and Florida. My background in finance and corporate accounting. While I was doing my full-time CPA job, I was also investing in real estate. I did some work as a wholesaler and did rehab some property. But now I'm focused on being a great realtor. And from an investment standpoint, I focus more on long-term passive real estate investment. Currently, I own 7 units, and some of them are short-term, Airbnb, and some of them are long-term, your typical one-year lease. I am committed to helping individuals and families in our community achieve their real estate dreams and build wealth through real estate. On a personal note, I'm happily married. I'm blessed to be called a dad. My wife's name is Precious. I sometimes call her Tominsin. My son's name is Iriolua. So if you want to with me to talk about real estate, feel free to scan the barcode and add me on Instagram or Facebook, and I'll be happy to connect. I do enjoy meeting people and getting to know people. So Um, here's our agenda for today. Since our understanding of real estate and experience with real estate is very different, I'll go through some basics when it comes to equity before I get into the weeds, right? So for the very experienced people, please bear with me. So what is real estate equity? Real estate equity represents the difference between the market value of a property and the amount owed on any existing mortgage or loans against a property. So, Mr. Johnson is a friend of mine. Let's say I bought a house for him. I will have an example on the screen, but I'm just going to add some numbers and dates to it so that you guys can really understand. So let's say I got a house for Mr. Johnson in 2020. Their house was 400K. He used conventional loan financing and he put 5% down, right? So his outstanding balance is 380K. So as of 2020, his equity is 20K, right? Obviously not considering the closing costs and everything it costs to sell his house, but theoretically his equity is 20K. So let's say that Mr. Johnson called me in January 2025 and said, hey, I'm thinking of cashing out using some of my equity to get an event center. I want to get a multifamily. I want to sell my house and move to New York. I want to sell my house and move to Africa. I'm tired of America for whatever reason. What is the value of my house, right? So I look at the MLS, I look at other comparable properties, let's say 4 bedroom, 3 bath, and I say, you know what? I see some similar houses go for 480K to 530K, or maybe even 570K, depending on the upgrade. Does it have a pool and other factors? Is in the cul-de-sac, things like that. Mr. Johnson's like, hey, no, like you're making my life complicated. Can you give me an exact amount? And I tell Mr. Johnson that, hey, the market does not work like that. I don't know what your house is exactly going to go for, so I can't give you a specific amount. And he's like, you know what? Just give me a number so that I can plan. So I say, Mr. Johnson, I think I'm comfortable saying you have a good chance of selling your house for 500K, right? For your planning purpose. So in 2025, his house is 500K, right? That's the equity. He's not sold it yet. right? So he asked me, how much am I going to make on this house? And I asked him, Mr. Johnson, what is your outstanding loan on the house, right? When we got the house in 2020, you owed 380K. So Mr. Johnson looks at his number and says, you know what? I've been very aggressive towards my principal. I've been paying my mortgage twice a month, and I got a bonus from work and I attacked my mortgage. And now my outstanding balance in 2025 is 300K, right? So Mr. Johnson has 200K equity. Can we please mute and mute some background noise? So so that's your equity, right? Your equity is the difference between let me see. Okay. Olin, can you mute? Sorry, I made some background noise.
I'm
No.
on mute, sir.
Okay, it's better. Can you guys hear me?
Yep, all
Okay.
good.
All right. Sounds good. So let me bring this up. All right, sorry about that. So anyways, that's the difference, which is the equity. So real estate equity is a financial metric that we should all be keeping track, whether we're trying to buy our first property or we are trying to sell our house or we're investing. It's critical for us to have understand that number, to assess the leverage we have, right? So that's important. So I hope everyone understands how equity works and what equity is. And if you want to know the value of your house, you can always reach out to me and I can run a comp and we could assess your potential equity. Again, it is a range. Until you sell your house, we don't know exactly what that difference will be, but we can give you some estimates to think through. So how do we maximize equity, right? Especially when you're buying or you're an homeowner, right? You want to make a larger down payment, thus reducing your standing loan, right? The second way is choose properties with potential for appreciation. And how do you know this? For example, if you look at the Dallas area, there are major plans to, expand or come up with an airport, a McKinney International Airport that might impact equity. Texas Instruments is building a fab, a manufacturing facility up north in Sherman, right? That impacts equity. The city of Dallas is trying to build a dart that goes from Plano to Fort Worth. Things like that impact equity. The Dallas tollway is being expanded and it's going to go through Prosper and Salina. So, and if you look at around Dallas, there are pockets of communities that are going through gentrification, right? So that's an easy way to access equity. So you want to know what is the master plan of specific cities, right? The good thing about this country is they plan things in advance, right? They have 10-year plans, 15-year plans, city plans. So we just have to do our research and also get to, and another way to know what the plan of a city is when you talk to a builder or a developer, right? They're invested in the plan for that city. So they typically know what's going to be built around, and all that information impacts equity. Thirdly, you want to renovate and improve the property. Home improvements like, upgrading your kitchen, your bathrooms, landscape, AC, roof, do help you gain equity and maximize your equity. Contributing more to your principal balance. I think many of us know this. Like in Mr. Johnson's example, it was paying his mortgage twice a month, right? So, instead of paying it once a month, you pay it twice a month. I mean, if you do the math, it's like you're paying a little bit more. So instead of typically, and I don't want to get too mathematical, 12 months times two should give you 24. But it doesn't work like that if you're doing it bi-weekly. You might end up getting around 26 weeks. So you actually pay more towards your mortgage when you do it like that. And I think it decreases it by 8 years. But the key to this is you want to do it earlier, because you pay about 80% or 70% of your monthly payments towards your interest in the first couple of years, right? So the earlier you start attacking your debt earlier on, the more reward you will get in terms of just equity and paying down your actual loan balance. So and lastly, obviously, we all want a low interest rate. So when you're purchasing a house, I always encourage my buyers to shop around and make sure they're getting great interest rate. And if you can't get an interest rate or you're not happy with what you have, I mean, I understand right now, the interest rates are high. Actually, historically, they are not high. If you look at interest over the last 20, 30 years, but I understand that in the recent years, 5, 6 years, they are comparatively higher. You can refinance in the future. And that's something I took advantage of during COVID. I was fortunate enough to have a couple of properties before COVID. And when COVID hit, I was able to refinance them to like close to 2%, right? You can't change the price of a house, but you definitely can always change your interest rate. So you want to know what's going on in the market and take advantage of that, especially for people buying houses around this time. Um, um, so the question now is, how do you leverage equity, right? One popular way to do this is through HELOC, right? It functions like a credit card. It allows you to borrow against the equity, typically a lower interest than other loans. And it can be useful if you're trying to renovate your house, if you're trying to invest in a particular business. And typically you're allowed to borrow 80% of your equity. So in the example I gave, outstanding balance is 300K. The equity is 200K because the market value is 500K. So typically, if you call a bank or a lender, your lender will say, you know what, you're approved to get 80% of that. 80% of 200K is 160K. So it's like getting a 160K credit card, right? To do what you need to do, but with some specific terms and stipulations. So that's what HELOC is for. It has a variable interest rate, but right now, HELOC is more popular than the other option we're going to look at, which is a cash out refinancing method. And you can talk to a lender. I mean, I have a lender that I work with, and they can give you more details and advise what's best for your specific situation. The other way to leverage equity is through cash refinance, right? It's a process that allows you to change the structure of your loan and refinance your mortgage to access more capital. So it will increase your mortgage balance. So, for example, the example I gave, you have 300K outstanding balance. So a HELOC is going to separate it and say you have 300K, you're going to keep your interest rate, and this is the terms for the HELOC. A cash refinance combines both together and says, you know what, we're going to give you 80%, which is 300K plus 160K. So your new mortgage balance will be 460K. And they come up with new terms for that, right? And sometimes I know some people are like, oh, that does not make any sense. Well, it might make sense because if let's say it could make sense, it might make sense for two reasons. One, what are you using that 160K for? The question is always, is your return on investment greater than your cost of borrowing, right? And if the answer is yes, yes, it does make sense. And it could depend on, for example, if you were trying to do a cash out refinance during COVID when interest rate was low, let's say you got your house for 5% and you do a cash out refinance during COVID and now you are at 3%. Yes, it does make sense. So it's all about market condition, and that's why we always upon ourselves to know what's going on around us. I send monthly newsletters to my clients. If you're not getting my newsletters, let me know. And I try to make sure everybody's getting critical information that impacts your decision as a investor so that you know the right time to act, especially when you have leverage in the market. The third one is leverage for investment purposes. I already explained that, but the main benefit of that is that you want your rental income to help you pay down your mortgage while your property appreciates over time. So this slide just brings everything we just said together. So I thought it was cute. I found it somewhere and I thought we should just show you guys. We really have the power to build equity. So this slide is more about maximizing equity when you're about to sell your property, right? The first thing is you want to sell at the right time, especially when it is a seller's market, right? What is a seller's market? A seller's market is when demand is high and inventory is low, as this leads to more competitive offers and higher sales price, thus maximizing equity. Shortly after COVID in 2021, 2022, some people were listing houses that should be sold for 200K, for 500K. It was ridiculous. And as a realtor, I almost every contract, I had to be putting addendums out there, basically saying that, hey, if you put a house that let's say should be valued 300K and the lender says, I can only borrow you a loan based on 300K. If you put for 500K, my buyers were ready to pay 200K more from their own, savings, right, to get this house. And the lender was not willing to insure that or lend them that money, right? So that was the market. That's what they call a seller's market, right? When you have very high demand and low inventory. Obviously, that's a good time to sell, but many of us, life doesn't work that way, right? We have to sell when we have to sell. We just can't wait for the market, and nobody even knows when it's going to be a great seller's market like that. I mean, actually, the COVID one was like almost once in a lifetime. That kind of situation hardly happens. But there are definitely situations in the market whereby the market tilts more towards the seller, it tilts more towards the buyer. The COVID situation is probably more dramatic, and we might not see that in a very long time. But that's what you want to know. Where's the market? Is it tilting more towards the seller side? Is it tilting more towards the buyer side? And what leverage do I have, right? And you can also prepare the property for sale, right? I encourage my clients that want to sell houses, try to stage your house. The statistics shows that houses that stage move faster, they sell faster. But the other improvement you can make, obviously, is like to your kitchen. You want to make sure there's no AC or foundation issues that might impact inspection and the loan process, especially for people that might go through the FHA process. There are a little more restrictions getting a loan through FHA. And if you have roof or AC or foundation issue, the buyer may not even be able to buy the house. You want to avoid overpricing. I know everybody wants to make as much money, but if you overprice your house, the house stays on market for too long, you lose leverage, and it could just impact our ability to sell your house correctly. So, um, but anyways, that's how you want to acquire equity as a seller. You want to really understand where you are in the market and just trust the numbers, trust the comps. And if there's a one-off comps, you want to know why. And that's part of my job as a realtor. We talk to other realtors all the time to understand exceptions and what's going on. So let's talk about how do you leverage equity. You can use equity for your next purchase, like we just talked about. You can move money from a house through HELOC, through cash refinance, and use it to purchase another house. If you're selling an investment property, a 1031 exchange allows you to defer your tax by reinvesting the proceeds into a similar property, which helps you save money on taxes. However, there are a couple of caveats, but there are two main caveats. You must find another property to move their money to, or you must identify a similar property within 45 days. And the other caveat is you must close on the property in 180 days, right? And again, this is only applies when you're selling an investment property, not a residential property. Now, you might be able to convert a residential property to investment property. I think the rule says you must have been using it for investment for the last 2 years, but that's a discussion with a lender. But that's a way you can leverage equity. You can also use equity to fund other businesses, and get into commercial real estate, like we've talked about. So just other tips, I touched on some of this. You want to stay informed about the market trends because it can have a huge impact on real estate, but also the market moves quickly sometimes. So, we don't always have the leverage to just like not pay attention to the market for months. It moves quickly sometimes, and the faster you are to get an information and act on it, you're probably gonna be winning the situation. So you want to also know what's going on in your local market. I just shared with you guys some of the developments that's going to go on in the Dallas Metroplex over the next 10 years, right? So what are we doing with that information? And even with the new administration, with everything going on, sometimes we'll get caught up, so frustrated. But as investors, we need to take a step back and say, what are we doing with this information? Where are the winners? Where are the losers, right? And how can we be on the winning side? Right? Because in any situation, the people that are using that information to make their life better, the people that are using that information to just not do anything and complain about it, right? We can't, we already voted, we can't change anything. So the question is, what can we do about the information we're getting and how can we make our lives better? And staying on top of the news, especially financial news, is important. You want to monitor your debt to income ratio as a future buyer, it's important to manage your debt levels, especially when leveraging equity, right? They're still going to look at what your current debt to income ratio is. I'm not a lender, but from the little I know about lending, I know that you want to stay below that 40% debt to income ratio. And what is debt to income ratio? Your monthly debt versus your monthly income, right? When you start going above 40%, lenders can still help you out, but you may start using bank statement loan, your tax returns, and less conventional ways of getting funding. And it's just a little bit more. But if you can, try to stay below 40%. Um, Tax considerations, you should always be aware of the tax implication of what you're doing, of gains or losses from real estate. And if it was a primary resident, you may qualify for capital gains exclusions, right? So if you sell a primary residence and you have, you might, if you're single, you might be excluded for 250K from the capital gains, and if you're married, you have up to 500K. You also want to have a long-term investment plan, right? You should have a clear strategy how you intend to grow your wealth with equity, right? For many people, it's buying a property a year. But also, you also want to say, okay, how can I diversify? Am I buying in different cities, right? Am I buying out of the state? Am I going to Florida? Am I going to Oklahoma? So you really want to be open-minded, and it just doesn't have to be residential. It could also be commercial. It could be a storage unit. It could be an event center. But have a clear strategy of what you're trying to do and understand your equity potential as you're making all those calculations. So, so this is the towards the end, and I'm going to open it up for questions shortly, shortly. But the key takeaway you want to have here is like, you want to know whether you are in a seller's market or a buyer's market and act as fast as you can, right? So that's your market decision and impact decision making. You want to understand seasonal trends. For example, in real estate, you can sell or buy a house anytime. However, spring and summer are the peak seasons of real estate. The spring, the weather is better, people are coming out. Summer is back to school season. Kids can come out to check houses, so there's just more activity. I've seen good and bad deals done either ways. Sometimes if you have more sellers, it could also mean there are some more motivated sellers. If you have less sellers, so it could go either way, but just be aware. I mean, if you're trying to sell your house, I'd probably recommend you sell it around the spring and summer season because we just have more buyers, and more views on your property. You want to keep track of comparable sales. Like I said, I can always run you a comp for your property. Just text me your email, and text me your property address, and I can always do that for you. Monitor interest rate. You want to know where the interest rate is, what the Fed is doing, or what the market is saying. So that's it for the presentation. And I will open it up for some questions. I know before we started this meeting, I spoke with Mr. Johnson. If he has some examples of people using HELOC and cash refinance and how it's made their life better. Mr. Johnson, are you there?
Yes, sir. I'm here.
Okay. All right. Do you want to say anything about the HELOC and cash refinance and what you've seen, or an example just so people can understand more of what that does?
Definitely. Yeah. Thank you very much for the presentation. Yeah. So basically, if you are sitting on some equity right now and you want to get some cash out of that, looking at the current interest rate regime, it appears using HELOC is more advantageous to you than using cash out refinance. And somebody will ask why. HELOC is home equity line of credit. Okay, so you can take some money from the equity that you have and put it on a line of credit similar to credit card. So as and when you need it, you cash it. As and when you need it, you cash it. So I have some clients who decide to take some equity from their house and use it to pay their children's tuition in college. Others to take the HELOC or take the equity to use it as a down payment for another house, whether as an investment property or as a primary residence. And even I have one client who also wanted to use the equity from his house to buy a restaurant. Okay, so there are diverse ways you can use the HELOC. But what I really want to emphasize is that if right now you are considering something of that sort, we need to have a meeting. So, and as to be mentioned, I'm a lender, so I'll know what will be more appropriate for you. But just on the surface, right now, it appears refinancing or cash out refinancing is not an ideal way to go. Because, for instance, if your current interest rate is say 3% or 4%, in this current market, it may be very difficult to get 3% interest rate. I know some of the bidders try to say, okay, we can give you 3.99. Others say we can give 4.5 and all that. But not all of them are true. Most of them, you have to still pay for it. So if you have such a low interest rate right now, it will be better to go for HELOC if you want to get some equity from the house. Because with HELOC, it doesn't impact your current payment structure. So for instance, if your current mortgage is say 3,500 a month, you can still take some equity from your house without having any change in that 3,500. But if you take cash out refinance or if you refinance, it's going to change the payment structure. So instead of let's say 3,500, you may have to pick the current interest rate, which will be higher than the 3% that you have. So instead of paying, let's say 3,500, your payment can go up to, let's say 3,800 or 4,000 or 4,200 or something like that. So that's what I would say, that right now, if you want to do anything to get money from your equity, consider HELOC instead of cash out refinance. But everybody's situation is different. So if you have any question, just talk to Toby, and Toby will give you my contacts, and we can talk. We can have a meeting, and I will see which one will be more appropriate for you. Thank you.
Thank you, Mr. Johnson. And I apologize. I just noticed I was not on video. So, but anyways, good to see you, Mr. Johnson. Any other question?
Yeah, this is Lawrence. Hi, Toby. So my question from
Lawrence,
the
hi,
junction
what's
is that,
up? See you.
yeah, good to see you.